Well, let's get another perspective on what's happening across these markets, specifically around the mining and energy space. We're pleased to welcome Peter O'Connor from Shaw & Partners back to the program. Peter, good to go and see you there. Lots going on in the commodity space as usual at the moment, and there's also a couple of big conferences taking part this week. What can we expect to hear out of those events?
Good afternoon. It's a really busy week again, and it has been busy for a long time in the sector, and a lot of news flow this week though. So two big global conferences this week when a bunch of mining companies, about 70 CEOs get together. It happens to be in Miami where it's sunny and a nice place to be at this time of year, meeting with somewhere around about 300 global mining investors, so talking about the state of the industry. So what will be topical? Firstly, why are our share prices going down, not up like they have been, and trying to bridge that gap. Secondly, the whole decarbonisation thrust will be a clear theme of the ongoings, and also the pathway towards the new energy transformation. That'll be key. And then just the day-to-day stuff about COVID, China, inflation, supply chains, labour availability, labour pressure, etc. So a lot of news this week, a lot of PowerPoint presentations, and a lot of discussions formally and informally at that conference. So we should see some stocks take direction from that over the course of the week and next week. So some of this route we've lived through over the last 4-6 weeks, it may start to see a little bit more calm in time.
Interesting, Peter, because you've alluded to the share price movements that we've seen, mostly to the downside. Is there value now emerging in some of these metals and mining related companies?
Indeed, that's a great question. I'm always try to take a positive take on things, and yes, there is the short answer. So I can say with conviction that we are still in the uptrend that started in January 19, 2016. So it's 7 years in duration. We've put on 300% in the mining index in Australia in $8 terms. That continues, but what we've done is to see consolidation in a recent uptrend. So we had a very sharp rally from November low last year when China was at its softest. We put on about 30% in the index, and on April 19, things turned lower. Why? China, COVID, shutdowns, etc., supply chains. And we've seen the sector pull back about 14% so far, and a little bit more today, so probably getting close to 15%. But to maintain that upward trend, we've probably got about 5 to 6% to go before we get to that lower limit of that uptrend. So we're still favourably disposed longer term, shorter term probably a bit more downside, and over the next days, weeks, and maybe month, we should see some consolidation in the sector. So value is definitely there, and to pin a number on that, 2/3 of my coverage is now trading what I call value territory, i.e. I can buy a mining share for 2/3 of my portfolio at less than fair value. That's a pretty good outcome, and on average, my portfolio is trading about 0.9 times fair value, so it's pretty well placed. So I'm starting to see opportunity. Maybe today's not the right time to venture up, but it's worth just being prepared, being ready, watching the screen, and there's going to be an opportunity in literally days or weeks ahead.
So it's in the sweet spot. So what particular names do you like at this juncture, given there's so much going on, particularly that uncertainty relating to what's going on in China?
The real standout, I think I've said this for quite a while on the show, so I have been early, but gold. Gold is just extraordinarily cheap. So every gold equity, bar Newcrest, that I look at is trading what I call the naughty corner, i.e. they're trading close to their 52-week low or at their 52-week low, and they're trading a deep discount to fair value. One standout name, St Barbara Mines, trading about 0.5 times fair value, so half fair value, and trading at a 52-week low. That's cheap. Now, it's got problems and it's got issues, but most companies do. They're working through that. They're presenting a good investment case to the market. But the key thing was last week there was rumours about M&A activity. A new company run by a former CEO of Saracen Mining, Raleigh Finlayson, apparently his new company Genesis is sniffing around St Barbara. Why? Because it's cheap. If he went out today and paid a 30% premium to buy that company on market, he'd still be getting it for a huge discount to fair value. So watch that space. Golds look cheap. Something will trigger them in the near term and they'll start to move higher. Also in that category, Sandfire, probably the standout result from the recent quarterly reporting season. Copper play, globally based now, not just Australia, doing great things, and that came out in their quarterly last month, and they're trading at a 52-week low. Why? Copper headwinds. So that's one to watch out for as well. And some of the big names in the EV-related space, so the lithium plays, Pilbara, Alchem, Aluka, even Oz Minerals in the nickel side, they've all pulled back from their very stretched valuations, which the market ceased to chase, and now trading back closer to fair value. So standout for me is lithium stocks. I can buy it today. The cheapest I could have bought in the last 18 months, going back to December 2020. So starting to see some opportunities in that new energy space as well. So there's lots of things coming up. So as these pullbacks occur, values emerging. Again, be patient, be ready, watch the screens, know what you want to buy, and you're going to get a chance to add to portfolios in literally days or weeks ahead.
Well, what trigger are people watching out for, Peter? I mean, what practically do people need to see before pulling that trigger?
So partly it'll be just value in share price, but what will drive that will be data is obviously key, Nadine. So it could be the end of month payroll data, it could be the ISM data coming out to the end of the month, which is still 2 weeks away. It could be PMI data out of China, but it will be data related most likely, and it'll be on a global basis. So every mining stock will bottom on or around that day or that week. So it's probably, again, days or weeks away. So I'm looking at data, and it's probably going to be that more macro-based data. So thinking about the data that came out today in China, it's weak, but it's backward looking. So we need to start looking at data that's looking a little bit further ahead. So we're getting close to that inflection point, but I think maybe the data points you start to see coming out for the month of May will start to show a little bit of a turn. And also stimulus-related measures out of China could be key as well.
Very interesting. Thank you, Peter. I have so many questions. I'm making Scotty just pause for a second.
Nice.
But I know that you've got a buy on pretty much everything, except those that are really focused on iron ore. So that's Rio, it's Fortescue, it's Deterra Royalties. Why are they a hold and not a buy?
They are a hold, not a buy. For one reason is iron ore price is tracking lower over time, but the key thing in the very short term is steel price. Iron ore very much tracks steel price. Chinese steel price have fallen precipitously, like a lot of commodities have, and they've done that from May 5, just over a week ago, and they've fallen 15%. The raw material, the margin that steelmakers get is being compressed, and iron ore price is getting compressed as well. So we see iron ore price trading lower. So demand is weaker, steel price is weaker, but also recall that June quarter is the strongest quarter of the year for iron ore supply out of both South Africa, Australia and Brazil, the major suppliers to the Chinese steel market. So we've got abundant supply coming on against a market which is suffering from COVID-related shutdowns, steel price weak, margins compressed. It means they have to start pushing back on the value or the price of shipments. So I see iron ore price trading lower, therefore iron ore equities trading lower. That said, Nadine, they've all pulled back as well, and the standout for me, if I was to give you an iron ore name which I'd flip back from a hold to a better recommendation, would be Deterra. Why Deterra? It's a small play, it's a royalty company, but no operating exposure, no capex exposure, just a pure revenue exposure. So and what they do benefit from, even if price is going sideways or down, they've got the best growth profile of any iron ore company in the world over the next 3 years, driven by BHP, which is the company that's driving that royalty stream, and that growth is significant. So Deterra would be my standout, and it's literally 10 cents away from a time when I'd look to flip that rating over.
So Deterra is the pick in the iron ore space if you want to go down that path. Peter, to go finish off, I want to go ask you about the traditional energy names at the moment. We know there's not a lot of investment going on in that space. We know that prices are sky high at the moment. Is that a pretty good combination when it comes to the outlook for prices and revenues?
I find it fascinating, the dead sector, the sector is going nowhere. We've talked about this a lot over the last couple of months. It's on a slippery slope to nowhere, yet it's the best performing sector, and stocks are trading near 52-week highs. And I guess the point is that old energy is going to be around for longer to bridge that transition to the new energy. So on that basis, the older energy companies are going to continue to trade more fully. They're starting to get value in the market. I just take Whitehaven as an example. It was trading at $1 per share literally in the last 12 months. It's now trading at 5. It should be trading at 10. Based on every comparison you could use over the last 1 or 2 cycles for energy pricing, it should be double what it's trading today. Will it get there? Possibly. If only because of the capital returns they'll do by dividends and buybacks, that'll probably bump it up. But energy is going to enjoy cash flow and higher prices. And what we're seeing, even with global growth slower, the constraints and issues with supply driven by the Russian-Ukraine situation is going to keep those prices high. So energy continues to look very attractive on the old school energy side, and those companies will likely hold their ground if not trade higher. So I still like that sector despite the fact it's out of favour. And to your point, investors are starting to show interest. I'm getting more inbounds on this sector, which is supposed to be out of favour, than I have for a long, long time. And it's telling me people ultimately like to make money, which whether that's ethically right or wrong, and the whole ESG overlay should be holding them back, but they're actually starting to look around the sector because the sector's going up and everything else is going down. So I find that surprising, a little bit ironic, but that's where money's starting to look. So we may get that as being the next burst, and There's a lot of interest coming from offshore with international funds saying why these Australian energy companies trading so at a deep discount to what they should be trading at. So that may be the next leg in those names across oil, gas, and also the solid fuel coal as well.
Yeah, well, I was going to ask about coal. I mean, like these companies are making money hand over fist. There's no other way to say it. Where do you look for exposure in coal?
Oh, and in a time like this, you can buy anything or everything because they're all going up. And you can go into the nuances of a particular product that they produce, but each of them are on payback periods of about a year or a year and a half. So it's just extraordinary, the free cash flow they're generating. But it's probably a Stanmore is the one. It's a flavour at the moment because of its coal types. It's PCI coal or semi-soft coking coal, which goes into the steel industry. Really constrained by what's happening in Russia, Ukraine. And talk about a great acquisition, probably the second best acquisition of this decade so far with Stanmore buying their properties off BHP. So that's a standout. Whitehaven Coal, just because of the cash they're generating, and they're now talking about taking their buyback, which is for about $400 million, which they've bought back 1/3 of in just the last 6 or 7 weeks. They're looking to top that up, and potentially at the AGM this year, they may extend that buyback from 10% of their register to maybe as much as 20%. So if the shareholders won't buy this stock, the company will buy it back themselves. So that's another name. But again, anything or everything, Terramen at the small end, just the amount of cash they're making, paying down debt and deleveraging. It could be New Hope Coal, Coronado Coal, or the metallurgical coal space as well, doing well and paying down debt, and did a double dividend announcement 2 weeks ago. So I hate to be generic, but you could literally buy all of those names and you would do okay, given they're all exposed to that same thematic, with just slight nuances in between each one.